Well, let's look at the cycles in the US dollar. The long-term cycles begin with the 60.5-year cycle. As you'll see on the chart I'm going to show you shortly, the 60.5-year cycle last bottom in September of 1992. We're in the time band where it's due again. It's due between, February of 2009, give or take 3 years. So we're in the time band for the 60.5-year cycle. It's comprised of 3 phases of 5.5 years each. And these phases all have an orb of about 11 months. Within the 5.5-year cycle, we get 2 phases of 33-month cycles. And then the 33-month cycle is composed of 2 half cycles of 60.5 months each. And then that itself is composed of an 8.25 month cycle, 2 of those, give or take 6 weeks. Now you can see this on the chart of the US dollar index, the long-term one here. You can see the 60.5-year cycle, bottomed here in September of 1992. And it's conceivable it may have bottomed again in March of 2008, although as I'll show you shortly, I don't think that is the case. Because remember, there's 3 5.5-year cycle phases within that. And I believe that this one in December of 2004, when it dropped to 80.53, was just the end of the 2nd phase. We're in the 3rd phase now, which means our strategy is to sell all the rallies until the cycle bottoms. We also have to consider a presidential cycle. If you go back and look at that chart on the US dollar, let's go back and look at that monthly chart. You'll see that in the 1980s to 1992, when we were under Republican leadership, the dollar dropped. The policy was to have a more competitive market advantage for the multinational corporations to sell their goods overseas. And then in 1992, we changed to a Democratic leadership. And it took a couple years for the market to get going. It started up real fast right away, but then it came down to form a double bottom in 1995. And then the market took up, and guess what? It topped out at the end of the Democratic term, which was in the year 2000. By the time the Republicans and the George Bush took over leadership again in the White House, the dollar was near its high. But once again, the policy was instated that took the dollar down right until the year 2008. And right after the election, the dollar took off again, came down, took off again a little bit later into the early part of this year, but now it's falling again. So the question is it going to continue going down under Democratic leadership, or are we trying to form like a double bottom here, after which we're going to start a multi-year bull market in the dollar based on the political cycle? If we look at the intermediate term cycles, we notice we have a 33-month cycle, which is half of the 5.5-year cycle. And we can see that this one last bottomed in March of 2008. Okay, that was the half cycle to the December 2004 cycle. Now if we go back again, we know now that we're in the second half of this 5.5-year cycle, and the second half cycle, the 33-month cycle, is next due to bottom December of 2010, give or take 6 months. We're in that time band now. And you see that this cycle will break down to 2 6.5-month half cycles. The first part of that one occurred in November 26, 2009 at 74.21, just about a year ago. And the next 6.5-month cycle is due April of 2011, give or take 4 months. Well, if you overlap all of these cycles and their phases together, you'll see the overlap says the big cycle is due December of 2010 to May of 2011. And our price target, which I don't have time to explain to you how I calculate that, would be 73.28 to 75.23. And you can see we're getting very, very near to that with this week's low, which I think got down to what, about 75.85 on October 22nd, which happened to be one of our geocosmic critical reversal days. We can compare this to other currencies too. There's a very close comparison to the dollar yen. They have similar cycle lengths as the US dollar index itself does. And as the US dollar is pointing to bottom in its own index, it's also pointing to the same in its relationship to the yen. However, the cycle is a little different in relationship to the euro currency and the Swiss franc. There, the dollar is still pointed lower in terms of our cycle studies, long-term cycle studies. This is what I wrote in about the currency section in our 2010 forecast book, which comes out every year in December 15th, but it's written in November. And at that time I mentioned the key to the U.S. dollar and the willingness of the White House and Federal Reserve Board to support it via their policies would determine what the dollar is going to do. And recent political cycles suggest that the Obama Democratic administration will preside throughout the majority of its leadership in a stronger dollar. Otherwise, the consequences could be catastrophic for the greenback, as implied by some other geocosmic signatures, which I write about in that book. I also indicated there in the highlight that both the euro and the Swiss franc would fall to the lows of their older 4 and 8 year cycles, which are due in 2010. Perhaps falling as low as 112 in the euro. Our target was 112 to 125, and that was the time that the euro was trading at 150. And as you know, in June it fell right in the middle of that period. It fell to 118.75. But the dollar yen, I indicated, would be in a time band for a long-term 5.5 and 6.5 year cycle now, ideally due this year 2010, and close to the 80 level. And if you remember back in December of last year when this was written, the yen was quite a bit, the dollar yen was quite a bit higher, and here we are now. We got down to 80.39 in the yen on Monday, on the dollar yen on Monday, so those forecasts worked out pretty good. Here you can see a picture of the dollar yen on the monthly chart, and you see we're getting very, very close to that 80 mark, and very, very close to the 1995 low of 79.75, which I expect within a couple points of that, maybe somewhere between 75 and 82. Well, we're already there, but close to that 79, 78 area. I think the dollar yen's going to bottom too, and you're going to start a new bull market. But if you look at the euro, you see here that we've had the 4 year and the 8 year cycle already bottomed. They bottomed in 2010, so they're in the early phase of a new 8 and a 4 year cycle. So the euro against the dollar looks like, to me, it's going up and should make, in my opinion, a double top or higher to that 160, 161 area that we saw in the year 2008. So you can see the same thing in the Swiss franc. In fact, you had divergence there that the 8 year bottom of the Swiss franc here a few months ago, it did not take out the low of the last 2 years, whereas the euro did. So that's what we call intermarket bullish divergence, which told me at the time the Swiss franc is going to make a new all-time high, which it has, and I think it's going to continue up to 130 before we go back down to those levels again. So here's the idea that I want to leave you with. We want to buy the euro or Swiss franc in the longer term here and sell the yen. We want to prepare to buy the dollar index, especially between March and May of 2011, maybe a month or so either side, because the longer term cycles, say the shorter ones, can distort a little bit. And this weakening of the dollar may also relate to a geocosmic signature known as Jupiter, a correlation of a big rally in U.S. stocks from early 2009 to spring of 2011. I'll show you that chart, and then we'll entertain questions. And you can see in this chart, this goes back to 1872 to the present. It follows the movement of the Dow Jones Industrials to every degree that Jupiter moves through the zodiac. And it was due to bottom here at 6 degrees Aquarius, which took place in mid-February of 2009. Well, that was pretty close to the exact bottom, which was March 6th or 9th, 2009. And you see we'll be in a bull market right until we get to early Aries. It comes down a little bit in the middle and goes up again late Aries. That would be between January and June of 2011. And then you see this model portends a bear market going into the next 3 years to Jupiter's in Leo.